Evening, everyone, and welcome to our post-budget MLP Wealth webinar. My name is Paul Standerwick. I'm a chartered financial planner and one of the directors here at MLP Wealth. The idea of tonight is to provide a recap, some of the major changes in the budget and how they may affect you, and also talk about some ways that you can offset some of those more detrimental announcements. Whenever we're talking about financial planning, we're dealing with a number of evolving variables. Budgets are a perfect example of this and how the goalposts constantly move. Sessions like this are an opportunity for us to provide you with some useful information, and we will continue to run them quarterly, covering a variety of different topics. It goes without saying that this is not a substitute for a full financial review. So please do get in touch if you would like to speak to us. Just before we get going, a couple of housekeeping bits. Please keep your mics off or on mute because of background noise. It shouldn't be an issue. I don't believe you can turn them on, just in case. We will try and stick to 35, 40 minutes. And in the interest of not running over, we will deal with questions at the end. Please use the Q&A function at the bottom or the chat. I'll look at that as well. If we don't get around to answering anything, please use the QR codes at the end of the presentation. You can book in for a chat with either Sean or me. And finally, we will be recording. So don't worry if you don't want to take any notes. It will be sent round afterwards. So that's all from me. I will now hand over to Sean, who's going to go through the presentation.
Hello, good evening, and thank you for joining us. Welcome to this budget special MLP Wealth webinar. There's been a lot of hype both before and after, and what we're going to do is break it down for you and what we believe is most important. So just to introduce myself, I'm Sean Standerwick, Chartered Financial Planner, one of the directors here, along with Paul at MLP Wealth. So understanding how the budget will affect you with 4 actionable solutions. The agenda today will go through what was announced, the tax increases that could affect you. We'll also say, what can you do about it? So 4 actionable solutions. We'll go through a summary, and as Paul mentioned, there'll be time for questions and answers, a Q&A at the end, 5 to 10 minutes. Please do ask questions. It makes it far more interesting for everybody. It makes it more interactive. No question is too silly. If you're thinking it, someone else probably is. What was announced in the budget? It appeared that not much changed, and some say it wasn't as bad as feared. But that's not quite true. We're on track for the highest tax levels in UK history. This budget alone raised 26 billion in taxes. The Office of Budget, or for Budget Responsibility, OBR, announced weaker growth as well is expected. And with this mix of increasing in taxes and slower growth, they've said there will be less disposable income for people. Your money's not going to go as far. So 6 increases that could affect you. These are some of them, the ones we believe to be most significant to you. It's not an exhaustive list, of course. Number 1, income tax thresholds have been frozen. So it's announced they'll be frozen until 2031. The Conservative government originally froze these in 2021, the idea being a temporary thing. For 2 years it was announced. Being fixed now for 10 years creates extreme fiscal drag, as the tax thresholds will not increase in line with your income or inflation, meaning more people will be pushed across the thresholds. Middle and high earners are normally the worst affected by this, but nearly everyone will end up paying more tax over the long term. Number 2, inheritance tax or IHT changes. No surprise, it was announced that they are pressing ahead with pensions falling to the estate for inheritance tax from 2027. They're going ahead now with the legislation for that. Worth noting that if you're over the age of 75 when you pass away, there's also potentially income tax for your beneficiaries to pay on that money too. So IHT thresholds have been frozen to April 2031. We all have a nil rate band of 325,000, and that's been fixed since 2009. So if your estate is worth 325,000 and that's it, there's no inheritance tax due on it. That's your nil rate ban. If this had tracked inflation, or it does, up to 2031, it's projected that it would go up to 563,000. There's also the net residence nil rate band, RNRB, which is 175,000, and that's been frozen since 2020. It's estimated that this would go up to 245,000 by 2031 if it increased in line with inflation. And what this means is that there's an extra potential 616,000 in allowances that a married couple would have, or a married couple, if they did track inflation. 40% of that, the inheritance tax rate, means 246,000 in extra tax. In the tax year of 24-25, the HMRC took 8.2 billion in IHT receipts, which was a record high. The previous year was about 6 billion. Freezing the thresholds is projected to raise a record 14.5 billion by 2031. And more people will be tapered on the RNRB. So for estates exceeding 2 million, the RNRB is reduced by £1 for £2 over this threshold. So a single person completely loses it once the estate's worth 2.35 million, and a married couple lose it at 2.7 million. OBR figures show that by 2030, twice as many estates will be charged inheritance tax at 9.3%. And this means that changes are not, or charges, should I say, for inheritance tax are not only for the ultra wealthy. More people will get caught up in this, and certainly lots of people will get caught out by it. I wanted to take you through an example now. Sorry about the busy slide. I'll go through it and explain. Don't worry about reading this. So if we take a case study, a married couple here, Michael and Alice, and I want to show what happens overnight from the 5th of April 2027. Just to go through then the situation as at the moment, they have a house worth 750,000, cash 75,000, ISAs 163,000, unwrapped investments not in any tax favorable environment of 170,000. Michael's pension is worth $1 million, and Alice's is 220,000. So their total estate for inheritance tax purposes is 1,158,000. We mentioned earlier about the nil rate ban, so everyone has the 325,000. So between them, they qualify for 650,000. They also benefit from the RNRB. And between them, therefore, there's a total of $1 million that will be exempt from inheritance tax. And therefore, 158,000 would be charged at the 40% inheritance tax rate, leaving them with a bill of £63,200. Not insignificant. However, when the clock strikes midnight on the 5th of April 2027, suddenly these pensions fall into the estate, bringing the estate for IHT purposes up to 2,378,000. Now, interestingly, they also start to be tapered on the RNRB, start losing some of those allowances. And what this means is they have a total estate of 1,567,000 that would be subject to 40% tax. That comes to £626,800. So their pensions make a big difference. The RNRB I mentioned is tapered. That's 560,600 in extra tax. Number 3, cash ISA changes. It's estimated that 300 to 400 billion is held in cash ISAs. Now the limit remains at 20,000 for stocks and shares ISAs, but cash will be capped at 12,000 from 2027 for under 65s. So sorry, anyone that's younger, you're penalised for being too young. Now there are measures that they're looking to put into place. It's under consultation in order to get around loopholes. For example, transfers from stocks and shares ISAs to cash ISAs. People holding more cash in one way or another are likely to be paying some interest, some other tax or something along those lines. So be very careful. Interest rates are falling on cash. We've seen this. And inflation is projected to be higher for longer. Cash is likely to fall further behind inflation over time, therefore, be worth less. Now I just want to take you through an example of how the impact of interest rates versus what I've got down here is CPI, so that's an inflationary measure. So interest rates being a proxy for cash and investing. Worth noting that here we've got as an investment world equities. Most clients don't hold 100% in equities, and most people won't get exactly the Bank of England interest rate. But what's really interesting to see here is that even if we look at the difference between the interest rates and inflation, is lagged very far behind over this 20-year period. This is historical, of course. Also, what we notice is that the performance of the equities has been significantly higher. And we do expect, of course, similar trajectories over time. So it's really, really important to look at this. Number 4, savings and dividend taxes. An extra 2% will be added to savings rates from April 2027. And an extra 2% will be added to taxes, dividend taxes, from April 2026. Who will this impact? Cash savers, as well as people with unwrapped investments. They will be penalized. For example, GIA's general investment accounts. I just want to take a break here and a pause just to say, Paul, my headset is running out of battery. Can you let me know at any point if you can't hear me, and I'll need to make some adjustments. Sorry about that. Business owners typically withdraw high levels of dividends, so this will impact them. As an example, after the changes, someone drawing 200,000 in dividends will be taxed a total of 60,280. This will also impact investors holding single company shares in what I call an unwrapped environment, so not in a tax favorable environment. Number 5, pensions. So salary sacrifice is currently a very tax efficient way of investing into pensions. It was announced that there will be a cap of £2,000 on national insurance relief from 2029. Because making those pension contributions by salary sacrifice saves a lot in NI, national insurance, for both an employer or a business owner, as well as the person themselves. Middle and high earners will be hit the hardest. Your work pension contributions could be impacted. So today, most people's work contributions go in to a pension via salary sacrifice. This means you're going to have less going in. And there's going to be an increase in costs for business owners. A £60,000 lump sum into a pension could cost an extra £13,000 once this change comes into effect in national insurance. Now, just a caveat here, this depends on your total earnings. It was just an example. Number 6, venture capital trusts, VCTs. These offer, if you invest into them, 30% income tax relief, tax reducer, meaning you have to have either already paid the tax or pay it within this tax year. You can invest up to £200,000 per annum. They offer other tax benefits, tax-free dividends, no capital gains tax. What was announced was from April 2026, the income tax relief will reduce to 20%. An example, if you invest 200,000 today, it attracts £60,000 in tax relief. Next year, that would be 40,000, meaning you lose £20,000 overnight in tax relief. We've gone through 6 changes that could impact you. And now the question is, what can you do about it? So we're going to go through 4 solutions. Number 1, pension contributions. Offer income tax relief. We know the thresholds have been frozen. More people are going to be paying more income tax. Business owners, instead of, or you could reduce your dividends and put money in. You can incorporate by doing so.
I think, Sean, you're running out of battery, so do you want me to take over?
Okay.
So business owners can reduce their corporation tax liability by making pension contributions. And yeah, that, Sean, if you want to move on.
Can you hear me now?
Yes.
Okay, great. I'll just take my headset off. No need for that any longer. So, I was just saying it will reduce corporation tax. Salary sacrifice. Take advantage before the rule changes come into place in 2029. Consider maximizing contributions before that. Some scenarios you may even wish to reduce some of your incomes to be able to do this. For some, the tax relief is equivalent to 60% because you get all the tax relief. Additional rate taxpayers also lose their personal allowance. It can work out to be the equivalent of 60% relief. People have an allowance of 60,000 that you can put into a pension per annum. You can potentially use carry forward. Just to note, not everyone can, by the way, put 60,000 in. But using carry forward, if you have it and you can, there are the caveats here, could potentially put 220,000 into a pension. So do it now, review this now, look into it before the changes come into effect. Ensure your pensions allow for beneficiaries' drawdown. This can avoid an immediate income tax charge if you die over the age of 75 for your beneficiaries. And it also allows them to retain that tax-free wrapper that's taken you all those years to build up. Regularly, we find when we review people that they've either not got beneficiaries or they're outdated. They may even have wrong people on there and certainly not some people that they want. Also, make sure that someone understands this and can help on your death. We can, of course, help with this, and we do help our clients as an example. Number 2, business relief. This is an inheritance tax solution. What's great about this is you retain ownership. You don't give any money away. If you invest into a scheme, after just 2 years, there's no inheritance tax. And there's even solutions out there, accelerated versions, that cover 100% of the investment amount covers 100% of what would be due in inheritance tax from day one. And really interesting stat here, about 45% of people, sorry to scare anyone, don't survive those 2 years who invest into these products. There's a £1 million allowance per person for business relief. And one positive thing that came out of the budget, one announcement, was that you can use spouses' unused allowances. And between a couple, with some clever planning, you can potentially get up to 4 million into business relief products. By the way, if you're wondering why we've got a photo here of me and Paul, this has been around since 1976, originally set up to help things like family-owned businesses such as ours. Number 3, cash holdings and ISAs. Review any cash ISAs and any other cash holdings and consider investing them. Do it now, review it now. Make sure that you're not getting taxed excessively. Venture Capital Trust, VCTs. Number 4, so take advantage of the current rules. These are type of investments, but they don't work like others in that they have fundraisers. You can't invest at any time. They have periods where they're open, and once they've reached their capacity, they close. And they're expected to fill up exceptionally fast, given the changes that are coming about very soon. So do it now, review it now. Just a warning here, VCTs are higher risk investments. They allow you to invest in smaller UK companies. So this just leads me on to say, get professional help with this. The correct solution is dependent on your personal situation. It's complex. Speak to someone that qualified to do so, a financial planner. They can work this out with you. This, of course, is where we can help. Just to note, anything I've mentioned shouldn't be construed as advice. To summarize, there've been a lot of stealth taxes. We are on course for the highest tax burden in history. We went through 6 increases and how it could impact you. We went through the 4 solutions. Number 1, pension contributions, business relief schemes, reviewing cash ISAs and cash holdings, VCTs, and again, just said get professional help before taking action. We have lots of free content for you, quarterly webinars. We have a monthly newsletter. If you're not receiving this, please let us know. We'll get you signed up. No cost to this. Don't even need to be a client. Guides, same there, roughly monthly. We also save them onto our website. We have various other articles with financial tips and information for you as well. Very active on LinkedIn. I post between 3 and 5 times a week. Paul, most weeks 2. So have a look at our accounts there with more tips and information for you. And finally, we have an Instagram account. Next webinar, the topic will be on pensions and inheritance tax. So we've had some more news on this. We can go through this in more depth. When? March 2026. How can you sign up? Well, keep an eye on your emails. If you're on our newsletter list, you will automatically be emailed. If you're a client, you should also find out. Just let us know. If you want to sign up now, we'll make a note of it and make sure that you are. If you can't make it at any point, by the way, but you're interested, always worth signing up because you will get a copy going to your inbox. Well, Paul and I are here to help you. So if you've got any questions following this, then you want to go into more depth, you want to review things, you can book in a call with me. So on the left-hand side here, there's a QR code. If you scan that with your phone, you can book a call straight in with me. On the right-hand side, you can book one in with Paul. Alternatively, here at the bottom of this slide, you can see our email address and phone number. Make a note of those if you don't have it already, and just say you would like to arrange a chat with either of us or an advisor. I'll leave this up for a moment just to give people the opportunity to take a note of it or scan them. So finally, moving on to the Q&A session. Paul, have we had any questions come in yet?
We've got a couple, so I'll read through them. First one I can answer if you like, Sean, and then maybe the second one you can respond. So the first one is, for those on final salary stroke career average pension schemes, will the salary sacrifice cap affect us? My understanding is no, it will not directly affect you. If you think about the way that a DB, defined benefit pension, works in principle, you know what you're going to get out at the end. Most of these public sector kind of schemes, which most they are generally speaking now, don't operate on a salary sacrifice basis. And I think really it's for the people who are going to see the bigger difference are people who are actually putting money into their pensions to see that grow as an investment, because what's happening is you're getting the uplift of NI. So for example, where employers have not had to pay the NI, some will rebate that into the pensions. You can actually get investment growth and see a direct result in the end fund value. I believe that it will, thinking about it, probably make DB schemes more expensive. So long term, there could be some indirect effects. But aside from that, I think you should be okay. Second question from Sarah. Question about the transference of investment ISA to cash ISA. Not planning it now. It's under consultation. Please keep us posted. Okay, it's not a direct question, but I think the idea there is that, you know, they're not going to allow people to move investment ISAs into cash to circumvent the rules, because you've already built up a holding in the investment ISA. They're not going to be allowed to transfer that into cash to somehow get around the rules. We don't know is the simple answer to that. Exactly what measures are going to be put in place. That is, like you say, under consultation, like Sean mentioned. So I think one of the points that Sean raised was that there are potential charges on interest within an ISA if you're exceeding those limits. But again, the detail is yet to come out, and we can let you know about this.
I'd also just like to add on that, I'm not sure there's necessarily a massive advantage in moving money from the stocks and shares ISA into a cash ISA. Now, these days, and certainly the ISAs that we offer are flexible. So if you need to take money out, you can do so within the same tax year. And as long as you put it back in that same tax year, then you can put the money back. So I'm just trying to think. I don't know whether you want to make a comment again on that, on what your thinking was and why you might want to do it, but I can't think.
So Sarah has actually just made a comment more for emergency funds. So yeah, of course, look, if you want to need to de-risk your ISA in the future, there'll be different ways of doing it. We have to see how the legislation actually pans out. So for example, you can hold cash within your stocks and shares ISA. So you could move some of the money you thought you're going to require it over the shorter term into cash. Again, this is where they may target some of that interest with some form of charges. But we don't know the
exactly. So
detail.
there's not necessarily, if you were going to have it in cash, you could still do it, even if you were to be penalised. But again, I think this is where, in that scenario of needing care, well, you can still have an income, you can still take money out from a stocks and shares ISA. I suppose it would need to be reviewed at the time. What are the costs involved? Therefore, do you need to take it all out? Do you need to take a large lump sum or anything else? Yeah.
Yeah, I don't just, I know you, Sarah, and I don't think that's going to be an issue for you, and it's certainly something we can discuss in the future. I wouldn't worry about it at the moment. I don't think there's one other question I just thought I would bring up, Sean, because we don't have any more in the chat. Oh, maybe we do. No, that was just Sarah. Which was, I thought it might be useful. You gave the example of that pension, falling into the estate and how dramatically overnight that can affect an inheritance tax bill. So I just thought perhaps for the people listening tonight, it might be useful to just understand again how those nil rate bands work and residence nil rate bands, and then the tapering of the residence nil rate bands, because there's a few bits to go through there.
Yeah, so everyone has what's known as a nil rate band of 325,000. Therefore, up to that amount, there is no inheritance tax. So if you're only worth 325,000 as a single person, no inheritance tax. Between a couple, potentially therefore double that, get the 650,000. So that's what I was showing in the example. The residence nil rate band, that's a further 175,000 if you qualify to that. For that, meaning you pass your main resident on to direct descendants. That then becomes tapered. So that's 175,000 each, sorry. And we can times that by 2 for a married couple. Where you start losing it is when your estate is worth over 2 million. So the impact of what I was showing was how adding those pensions, it was about 1.2 million, just over, makes a massive difference to the value of the estate. It took them over the 2 million. And so for every £2 your estate is worth over 2 million, you lose £1 of that allowance. So as a single person, or you would completely lose it at 2.3 million and the 2.35, and as a married couple, 2.7 million. Is that a bit clearer? Do you have any more
Yeah,
questions?
I think so. So essentially, you start with 325 times 2, 650 plus 175 each. That takes it as a married couple up to 1 million. But once you hit that 2 million mark, you start to lose that secondary allowance. So that's why in that example, the tax bill exponentially goes up at midnight when you move into the new tax year. So yeah, it's quite scary. So
Which is also why we will be doing a separate webinar just on this, because it's going to be big and make a lot of difference to people.
okay, we've got one more question. Did the budget have any impact on the Foresight ITS scheme? Sean, would you like to answer that?
Well, the Foresight ITS scheme is a business relief scheme. So the budget that we just had, what were the changes in business relief? Well, there was one, and that was the positive one, that you can use a spouse's unused allowance. So therefore, for example, you're married, if you have a spouse who passes away and doesn't use their business relief allowance of 1 million, so last budget they capped it at 1 million, you can still carry that over and use the allowance. So between a married couple, even if they didn't hold the product, you can potentially have 2 million between you. So that was something that was announced, which changed. But yeah, that is a business relief scheme, but nothing detrimental that came out in the budget that would impact that.
So I think you may have had the figure of 4 million in the slides, Sean. That just refers to you can use trusts. You can each use trusts as well. So you could have 1 million in your personal name, 1 million in trusts, and then you can carry over those allowance potentially. But I mean, in a direct answer to your question, as well, in addition to what Sean said, is we were concerned that unquoted shares that qualify for business relief, such as those in the investment you mentioned, could have their reliefs changed. A little bit like what's happened with the AIM market, where now you can only get 50% inheritance tax relief. That did not happen. So in the main, as Sean quite rightly said, the only news we had for business relief this time around was positive.
Yeah, there's one other thing I'd add on what you just said there, is that this is why it's so important not to make drastic changes, and any changes really purely based on speculation. So, there were rumors that income tax would go up whilst we talked about that, but it was frozen, but we was talking about it going up. But also, very importantly, was that they may reduce tax-free cash on pensions, maybe even get rid of it. And lots of people concerned about that. And if you purely had acted on the speculation, you could have ended up in a much worse situation. So really important to remember that one.
Yeah, I think that one gets talked about every single budget, the 25%.
Yeah.
So anyway, we don't have any further questions, so we'll just give it another 10 seconds or so in case anyone has anything else to ask. But thank you very much for joining us this evening. As we mentioned, you can contact us by phone, email, QR code. There will be a recording going around of this. So I think, having said all of that, thank you very much from me and Sean, and we look forward to seeing you and talking to you soon. Goodbye.